Good afternoon, everyone. My name is Tony Whitbeck. I'm the CEO with Advisor Legacy, and I can see people are just entering from the lobby. Looks like most people have now entered. So welcome to today's presentation on practice sale multiples, where we're going to separate the fact from fiction. Today we have a special guest with us. He's our Vice President of M&A, and Todd Doherty is going to take us through the vast majority of the content today. Just a little housekeeping. All of the telephone lines and cameras have been turned off. If you'd like to ask a question, please go to your control panel and there's a Q&A section and type in the question. And then at the end of the presentation, we'll do our best to answer those questions. It's super helpful if you have a question during the call to type it in at that time so that we have some questions that are queued up already when the presentation is over instead of waiting around for people to type in a question. So that's number one. Number two, we have a white paper on this topic. And if you go to the chat message area, you'll see a link. And when you click on it, you can register to get that white paper sent to you on practice sale multiples. It's been a very popular paper, so I would encourage you to download that. And it'll have a lot of the things that we're covering in today's webinar. So before I turn it over to Todd, I just want to give you a brief overview of the services that we offer at Advisor Legacy. And we like to think about them as along the advisor career path. So whether you're building your career or you're living and wanting to protect it, or you're getting ready to retire from the business and you want to leave a legacy, we have services in all of these areas. So you can see we have buying opportunities. We have a sales platform where we list practices for sale. We provide legal and lending support. We have partnerships with banks that lend to our space and law firms that work in our space. We provide buy-side deal support. So if you're the buyer and you have a seller and you're trying to negotiate and structure a deal and get all the paperwork done, we can help you with that. We do executive coaching. This is where we work one-on-one with the owner of the practice in all different areas. And then we do practice management. And we have a team of people that work with primarily the staff in the practice, looking at things like roles and responsibilities and workflows and proper use of CRM, basically making sure that your practice is running as efficiently as possible. So those are some of the building services that we offer. We do a lot of valuations. We do 300 to 400 valuations a year, not just for advisors, but also for some of the banks who lend in our space. We do continuity planning to help protect the value of your practice in the event of death or disability. We can help you establish an entity like an LLC and create the operating agreement. That's done through one of our law firm partners. And we can help you with both internal and external succession planning. Now, if you're at that stage of your career where you're thinking about selling, and you don't have someone in mind, we can help you find that buyer through our sales platform. We also could help with internal next-gen sales. So we're seeing more and more of these where the junior advisor starts to buy out the senior advisor, perhaps in tranches, sometimes all at once. If you have someone in mind that's your buyer, we can represent you. So that's sell-side deal support to help negotiate and structure the deal on your behalf, as well as the legal documents. We have legal support, and we even offer escrow accounts because normally when a deal is done, a percentage of the assets or the purchase price is held in escrow until an attrition clause is met. So we've really tried to offer a service in all the main areas in a financial advisory practice. I would say the only area we really don't get into much is HR. And that's because a lot of things vary state by state. And it's just a whole nother animal in itself. So with that, I'm going to turn it over to Todd, and he's going to take us through today's content. Again, please type in any questions that you have, into the Q&A section and download our white paper in the chat section. So Todd?
Thank you, Tony. Looks like we've got a good group online today, and I want to thank everyone for taking time out of your schedules to join us. So again, the subject for today is sales multiples in our industry. And the reason that we were inspired to create both the white paper and this presentation is over the past few years, we've really experienced a sharp increase in the hearsay, misinformation, and really misuse of sales multiples. And so we wanted to provide some context around that and really let you know how they are appropriately used. The common things that we hear are, statements like, well, I've heard every practice sells for a multiple of 4. And then when we question, what is that multiple of, they don't have the context. They don't know if it's gross revenue, net revenue, recurring revenue, and so forth. And then people say things like, I know an advisor who sold for a multiple of 7. And when we ask if they had seen the agreement, the answer is almost always no, they had not seen it. And frankly, I have not ever seen an agreement like that either. So there's certainly a lot of misinformation out there. And I think people like the hearsay because it sounds good. It's like kind of exciting. But it's not good to set expectations based on that. Certainly there are outliers. There's outliers in everything, and I'll discuss why we see some outliers, but outliers, again, are not something that you want to set your expectations on around the value of your practice and what you might monetize it for. So as I mentioned, there's very little context when people discuss sales multiples. And so I want to start out really providing some context around it. When we're talking about multiples in this presentation and in the white paper, we're going to use the most simple definition available, and that's the sales multiple of the gross revenue of the practice, or gross GDC. The example that you can see here, and again, this is a very simple methodology, is if you have a practice that's producing $1 million in trailing 12 revenue, and it sells for 2.3 million, that's a multiple of 2.3. So very simple, very straightforward. And those multiples are largely used, and I think appropriately used in most cases, as another way to express the result. The multiple didn't necessarily get the result, but it's a way to express results. There's other definitions which are also valid, and they're just different ways to look at it. Sometimes you'll hear about multiples of net revenue after the broker-dealer payout if it's an independent advisor affiliated with the broker-dealer. Sometimes you'll hear about multiples that just refer to recurring revenue, simply just the recurring revenue and no multiple applied to the transactional revenue. Also, that's appropriate as long as you understand the context. And then lastly, multiples of EBITDA are less common in our industry. But in the M&A space, multiples of EBITDA are pretty common. So all of these types of expressions of multiples of a sale price relative to revenue, whether that's net revenue or profit or so forth, are valid ways to look at it. But the important thing is that you understand the concept. And again, multiples are often appropriately used really to compare results. So let's look at some of the ways that we are seeing currently how they're being misused and really, I think, causing harm in the industry. The first is when people use multiples to actually assign value to a practice. And I can tell you that this happens quite often. So, if someone's looking at an acquisition and they just simply look at, some of the higher level metrics and they decide, well, this practice looks like it's worth a multiple of 3 of the revenue, then they're actually using that as their methodology to decide, what price to pay for the practice. And the opposite side of that coin is also true, where sellers are saying, well, I've heard that, everyone's getting a multiple of 2.5, so I'm going to go to my buyer and ask for that. The problem with that simplification of a methodology of value is it ignores the two most important parts of the value of a financial planning practice, and that being the quality of the practice, looking at the key metrics of the practice, the client group, et cetera, and the profitability of the practice. Assigning simple multiples would, take variable quality practices and practices with variable profitability and give them the same sale price. The other issue, or another issue, is exaggeration of actual results. And this is something that, again, we hear quite often, where people are making claims that all practices sell for very high multiples. It's totally unsubstantiated, and that any practices really that are above a multiple of 3 of the gross, and we'll show you the actual results of this, are outliers and hard to support with the cash flow. They really create unreasonable expectations, and this is an issue because you want to have reasonable expectations about what you're going to monetize the equity in your practice for, and certainly, what you would buy a practice for in an acquisition. If you're going to put, an estimate of the equity into your own personal financial plan, it should be a good one. It shouldn't be based on a simple rule of thumb using multiples, but actual professional evaluation. And then lastly, I think a lot of times people are mistaken the hearsay for industry level data. And unfortunately, in our industry, that data does not exist. There's no place where all of the results of actual practice sales are compiled at the industry level. And so when you do hear data from a firm like our own, it's largely based on our own experience. And there's nothing wrong with that. It's the best data that we can get. Probably fairly representative of the industry at large, but each of us works in our own lane, so to speak. And so I wouldn't take anything as being industry level data. It's just a good representation of what the market is looking like for practice sales. So with that in mind, it really comes down to two different things. The best way to determine the value of a practice is by getting a professional valuation. That's one. And determining what it's worth to you as a potential buyer should really be largely based on cash flow. And so I'm going to walk you through some of the cash flow considerations that we look at in the work that we do. So why is cash flow important? I ask the question to people, when they talk about, these really, extravagant multiples that they think someone was paid. The question that I would normally ask is, why would someone make an investment without the expectation of an appropriate return? That doesn't make any sense. And when you talk about these really extravagant multiples, that's exactly what that illustration would indicate, is that someone theoretically would make an investment that they wouldn't get an appropriate return on. So that's where cash flow comes in and why it's so important. The cash flow demonstrates the return on investment. So if we're looking at, the revenue produced by the practice, the price that's paid, the operating expense of the business, and the debt service for the acquisition, there is an appropriate return net of the expenses and debt service. Cash flow is also important because if someone goes in with a really high price and it doesn't support the cash flow, it can be financed. The banks certainly aren't going to try to finance something that won't cash flow appropriately, because it puts their debt service at risk, and it potentially puts the buyer into an unfortunate situation where if there was any stress testing of the model, if there's a downturn in the market, et cetera, that they wouldn't be able to make those debt service payments. And what you'll see in our scenarios that we've tested, multiples of 3.5 and higher are difficult and rare to cash flow appropriately. And how do we determine the cash flow? So we're going to show you an earnings model, or you can create a pro forma that basically looks at the same thing, that includes the following. The practice revenue with an annual growth rate assumption. Oftentimes people leave out the growth rate assumption, but it's important, and you probably wouldn't buy a practice if you weren't assuming to grow it. the operating expenses of the practice that's being sold or purchased with an annual growth rate around expenses, and then the debt service for the acquisition. I was going to share a story that happened last year with one of our sales just to kind of illustrate this point. And we had a sale up on our open market platform, and an offer came in that was ridiculously high. And minutes later, the seller called me and said, "Did you see that offer?" And I said, "Yes." And he said, "What do you think about it?" And I said, "Well, I don't think they could do that." And he said, "I don't like it either because I don't think they can make it cash flow appropriately either." Well, what we found out was in that scenario, the buyer's intention was to make up for the cash flow deficit by selling annuities to the clients. That was their way to resolve a very negative cash flow situation. If they would have paid that price, obviously the seller had no interest in that, as it turned out. So you might ask the question, how do you determine what is the appropriate cash flow? And there is actually a way to do that that we use, and it's what's known as a hurdle rate. And the hurdle rate is also known as the minimum acceptable rate of return. And that's the target rate for the return on the investment, basically the net cash flow after the expenses of the practice and the debt service for the acquisition. The hurdle rate determines what the net pre-tax cash flow should be. So you can see at the bottom here, hurdle rate is determined by assessing the cost of capital, risks involved, current opportunities for business expansion, rates of return for a similar investment, and other factors that directly affect the investment. A typical range of a hurdle rate is 17 to 23% in our models. So what you're seeing on the slide here is a cash flow model. This is based on a practice that has $1,137,000 in trailing 12 revenue. That's year zero that the purchase is based on. And the sale price in this case was $3.4 million. And the expenses of this practice were 50%. This is an example that we took from our models. 50% expense ratio is on the higher side. But I wanted to show a model here that is really at the limits of what would cash flow appropriately. If it was much less than this, this probably wouldn't be a deal that someone would be interested in doing. So if we start at the left-hand side of the illustration and move across to the right, the first column that you can see other than the year column is the starting revenue, and we're applying a growth rate to that revenue of 7% annually over a 10-year time frame. The growth rate of 7% in a model like this is about in the middle. Typically, the range that is used is 5 to 10%, 5% being conservative over a long period of time, 10% being a more aggressive rate, with 7% approximately in the middle. The next column that you see are the expenses of the practice. So we have the starting expenses, again, about 50% of revenue, and we're applying a growth rate of expenses of 2%. Cost of living increases and things like that. Typical growth rates of expenses are 2 to 4%. And then what you see is the debt service for the acquisition of the practice at the sale price of $3.4 million. And we have two different types of debt service here, which is very common in our industry. The first column that you see is the lender finance debt service, which is a 10-year amortization at, I think we ran this at a 7% interest rate. The second debt service that you see is a seller finance note for the 20% balance. The lender financed 80%. The seller's financing the balance of 20%. That's a 5-year or 60-month amortization at about a 5.5% interest rate. So what we're measuring here again, compared to the hurdle rate, is the net of the debt service and the operating expenses of the practice. So if you move all the way over to the right, you can see that the hurdle rate for this practice is pretty typical of 18%. And in year number one, the net revenue is 21%. So we're exceeding the hurdle by about 3%. In year two, the secondary note kicks in. So the rate goes down to 13%, which is shy of the hurdle by about 4%, closer to 5%. And then from there, it exceeds the hurdle increasingly so because the growth of the revenue is greater than the growth of the expenses. Again, this model illustrates a sales multiple of 2.99, which is pretty much at the edge of what will cash flow in most scenarios. So now that you have an idea of what a cash flow model looks like, let's look at some of the assumptions in the industry for these types of models and also some of the exceptions that we've seen really that create the outliers of price and multiples. So assumptions would be, and you can see this on the slide, that most deals would assume that pre-tax cash flow will be positive from year number one, so not a negative number of cash flow, and it would exceed the hurdle rate by at least year three. In some cases, it might exceed it in year one, but in all cases, you wouldn't want it to not exceed it by year three. The other assumption is that most deals today are financed by a lender. Most lenders, and that could be a bank or a broker-dealer, use a 10-year amortization. And the length of the lender's note has made a big difference in the cash flow models because the length of the payment or the amortization really has the biggest impact on the model other than the price. And then when we look at the exceptions, and again, these are things that we have seen over the years that have resulted in outliers, and there's not a lot of them, but there has been some, which is why they're outliers. The number one thing here you can see is a buyer can be willing to inject their own cash into the deal, and they don't have the same considerations of getting that paid back in the same timing, perhaps, that a lender would. We don't see that very often, probably more often more recently with larger and larger practices, making acquisitions, they do have more cash flow and more cash set aside. But it's also the case that the lenders would prefer to see that the buyer maintains a healthy cash reserve, and they don't necessarily want the buyer injecting their own cash, although you would think that they might. The other exception, and this one we see more in the RIA space, is where the seller is trading a portion of their equity for an equity stake in the buyer's practice. In other words, the buyer is using their equity as part of the sale price, or part of the payment of the sale price. This is the one, I think, in most cases that results in multiples that look very high, but there's a lot of risk that goes along with that. Generally speaking, the equity in the buyer's practice that's being traded for the equity in the seller's practice is based on a future valuation that has not been achieved, and that future valuation is usually based on some really healthy growth rate assumptions. So the seller has to wait for those assumptions to be met, if they will be met, and is not able to monetize that equity, usually for at least 3 years in the deals that I've seen that are trading equity. The other challenge of that type of an arrangement is that the seller is really forced to be in a position of becoming the buyer as well, because they're having to take the equity from the buyer's practice as part of their payment without really any ability to vet, whether that practice will be successful in the future. And then the last item where that creates outliers from time to time is if the seller is willing to take, creative or highly contingent terms that potentially result in a greater multiple, they also potentially result in significantly more risk. And these types of situations are, earn-out deals, deals that are, contingent on the future growth that the buyer might create in the practice. Anything like that where you're not getting a fixed price in payments and you're getting it based on an outcome that is not determined until the future. And again, we don't generally recommend these. Most sellers would prefer to have, a determined value of the practice and fixed payments for it. So let's take a look at, in our own modeling, what multiples of revenue are actually supported by cash flow. And so what we've done here is we've built actually 9 models for each multiple of revenue that creates the sale price. And the 9 models are variables of the expense ratio of the practice being sold and the growth rate of revenue that's being put into the model. And those are really the variable factors. The assumptions that we use are the same as the model that I showed you a minute ago, where you have an 80% lender financed note at 7% over 10 years and a 20% seller finance note at 5.5% with a 60-month amortization. So if we start with a multiple of 2, starting from the left and moving right, and we're looking again at 3 different growth rates of revenue and 3 different practice expense assumptions. And then you can see in the guide at the bottom that a result of 3 means it's exceeding the hurdle rate. A result of 2 means it's marginally exceeding the hurdle. And the result of 1 is it's below the hurdle and not acceptable in a cash flow model. So a multiple of 2 paid for a practice, you can see, is exceeding the hurdle rate in every situation that we tested, all growth rates and all expense ratios. When we get up to a multiple of 3, you can see that it's acceptable in the growth rates of 5, 7, and 10%, up to an expense ratio of 40%. But when you get to an expense ratio of 50%, the 5% growth rate doesn't work and the 7% growth rate is marginal. When we get up to a multiple of 4, and this is, again, the hearsay area that we oftentimes do here, you can see that it's not working in most scenarios. In fact, the only scenario that's green, or the number 3, is a 10% growth rate and a 30% expense ratio. The balance of them are either marginal, and most of them are not acceptable from a cash flow perspective. You get into a multiple of 5 on the other end of the spectrum, it's not supported, the cash flow is not supported in any scenario. Doesn't matter what the expense ratio is, and it doesn't matter what the growth rate is. And I think that really drives home the point that when you hear of those things, it's either an outlier or there's something else going on, or it's just simply hearsay, which I would say is probably the majority of the cases. So with that in mind, and the understanding that, cash flow is really the driver, we wanted to show you some actual sales results. And again, I'll qualify this by saying, these are our own sales results. There's not an industry level database where we can see all the sales that happen in the industry and those results. But again, I think very representative of the market in general. What we learned from our analysis, and we looked at sales over the last 3 years. So all of the deals that we've been involved in and all of our deal making services over the last 3 years, we put that data together. And what we found, the biggest takeaway of the database, and this is the first time we've done this actually, is that the differences in multiples that are actually achieved are highly contingent on the way the practice is sold. So I wanted to find the types of sales that we were measuring. So first you have what's called a closed deal. And a closed deal is where the buyer and the seller have found each other. They largely agree to the price and the terms. They negotiate it themselves and put the deal together themselves. That is the most common way that practices are transitioned in our industry today. And I would say it always has been, maybe always will be. So closed deals is the number one way that we see practices transition. The next category is a closed professional deal. That's where, again, 2 people have found each other, the buyer and the seller, but one of the 2 of them, normally the seller, decided to use professional help to negotiate and structure the deal. So we differentiate that by not, using the DIY model, but actually using professionals to do it. The next item is the next gen transition, and I think Tony mentioned a bit of this, is where you're transitioning the practice to the associate advisors in the practice, and it's generally purchased over a longer period of time, 5 to 10 years, through tranches of equity. And then lastly, open market sales. So open market sales is where you're publishing your practice for sale on a listing platform, if you will, and you're receiving competitive offers from, usually quite a number of potential candidates, vetting those candidates down from large groups to smaller groups until you can finally select the buyer. Open markets can be limited. That's what most of our open market sales are actually limited to inside of a specific broker-dealer or RIA platform and not totally open to the industry. So with that understanding, again, we looked at the data from 3 years worth of the last 3 years worth of sales to show you how those different types of deals or the different ways that practices are sold impacts the multiple or the price that's paid for the practice. And for this information that you see here, we use an average size practice based on our valuation model. And at the time that we put this together last year, the average practice was $1,137,000 in trailing 12 revenue. 90% of it was recurring, and AUM of 157 million under management. So if we start at the most common way practices are sold, a closed deal, again, two people putting the deal together themselves, DIYing it, you can see that the average multiple for the last 3 years was 2.31. These are actual results, not just valuation, which applied to that average size practice was a sale price of 2.6 million. When we go to a next gen deal, and most next gen deals are professionally managed because it's a relatively complicated process to put all of that together into the deal of purchasing tranches. We see a bit of an increase in the average multiple to 2.37 or 2.69 million in sale price. When you get up to the closed professional deal where the seller largely has hired professionals to manage the negotiation and structuring of their deal, the multiple jumped up to 2.78 or a sale price of 3.1 million, again, applied to the same practice. And then lastly, the highest average multiple that the data indicated was open market deals. And you can see here that average multiple was 3.39 or a sale price of 3.8 million. And you can also see here, and this is our big takeaway, that was, I think, a bit of a surprise to us, even though we knew there were differences, we didn't realize the average differences were this great. But you start at a closed deal sale price of 2.6, and then the range goes all the way up to 3.8 million, so over $1 million difference for the open market average deal. You can also see down at the bottom the average valuation results, and they align very well with the fair market process of trying to represent how are most deals sold, what is the average of the most common way that practices are sold, and it aligns really well the range of valuation results from 2.17 up to 267. So that's the actual results, again trying to remove some of the hearsay from the reality of what happens in the market, with the understanding that there are outliers, but outliers are not a good way to establish your expectations for a deal. So quickly, just to go through a few things, set appropriate expectations based on facts. Hopefully you've seen from the data that we've shared and the cash flow models and et cetera, a lot of the hearsay is simply not supported. It's just that, it's simply hearsay. And when there's a real deal that goes into those multiples, there's probably an additional risk that goes along with it, or something else in the deal terms that you may not be privy to. Practices, again, from a cash flow perspective, they really need to surpass that hurdle rate by year 3 or better. It depends a lot on the buyer's risk tolerance. And the good news is that you don't need to have these unrealistic hearsay numbers in your head when monetization of equity is the best it's ever been in our industry. It's still a very strong seller's market. Practice values are very strong based on increasing quality of practice metrics and profitability. all of those things have, just continued to improve over the years. And it's a very, very good time to monetize the equity of your practice. As Tony mentioned, we have several different services. So I'll just touch on these quickly about how we help people put these deals together. And that could be from the buyer's perspective or the seller's perspective. We have what's called our turnkey deal support. And that's when people have found each other as buyer and the seller, and they need various stages of assistance in negotiating the deal, structuring the deal. Maybe they just need to paper the deal and get the legal agreements completed. We really have options for, wherever the buyer and the seller are coming to us, and we can get the deal completed for them, whether that's an all-inclusive package or a straightforward papering of the deal. We also have our own open market platform, which you saw that data on the prior slides come from. And that's where we're listing practices for sale. We're engaging quite a number of prospective candidates. Most of our open market sales are limited to inside of the seller's broker dealer. And that's where the monetization of equity is certainly going to be the highest. I would also argue the fit can be a lot better too, because you're vetting a lot of qualified practices versus just choosing one because you happen to know that individual. So with that, I'm going to hand it back over to Tony, and then he'll open it up to whatever questions you might have.
Thank you, Todd. There is one more slide here that I thought I'll cover. Actually, there's a couple more slides, but so with our turnkey deal support, we have two different ones. One is our standard. As Todd pointed out, you can see the price is $59.95. And then if you're looking for more support, practice valuations, or we do evaluation and more meetings and legal documents, that's $59.95 plus 1% of the sales price. We believe we earn that through our negotiation and deal structure. And then for internal deals, which was our next gen deal support, this is really more of a collaborative approach than it is trying to negotiate between the two parties. Oftentimes, the seller may even want to provide some type of sweat equity to the junior advisor that's helped them build what they have. So we do a practice valuation. We have a buyer's earnings model. And this is really big for the buyers. Generally, they're going to be younger. And this is a big purchase for them. And they want to make sure they can actually afford to purchase the practice. So we're going to have more meetings with an M&A coach. There's 4 meetings. We're going to do all the legal agreements, and then we also do some transition planning. So because we're collaborating and not negotiating, but we're still doing a lot of meetings and work with them, we charge a flat fee for this. It's $12,995. So those are our 3 turnkey deal support services. When you look at our open market process, the way it works is if someone enlists us to sell their practice, we create a profile about their business, and then we publish it on our platform. And that published practice will be going out to about 1,500 advisors, depending upon the broker dealer. And they're going to get an email, and they can express interest in the practice. And the buyers are going to have a profile about their own business, because then what we're going to do is make a first cut with our seller to determine who might be a good fit. And then we're going to invite those people to place a bid on the practice. And then once the bids are in, we're going to narrow it down to a handful of people that we're going to interview. And then once we interview the 5 candidates, let's just say it's 5, our seller is going to select the person that they want to be the buyer, and then we help them with the transition. So on the buyer side, you can register an account to be a buyer. You can get notified when practices come up for sale. You can express interest in practices. You can place a bid and hopefully be selected. It's a very linear process. And it's a process that both our sellers and buyers like. So even though we're representing the seller in this situation, the buyers love the process because they know exactly where they are in the process and what they can expect moving forward. And we do our best to try to help our buyers make an educated bid on the practice. We want it to be a win-win for both parties. If one of the two parties loses, then it's just not a good deal. So with that, what I'd like to do is open it up to some questions, and let me get into the question area. Looks like we have a couple people in the chat too, so let me go there. So someone said I'd like to get the white paper on this topic, but I don't see a link to the request. And Todd, you already answered that. The link's right above the request. And let me get to the Q&A. So Caleb said, in your example, what would be the approximate fee in percentage that the seller incurred from an open professional service sale? Okay, yeah, I'll take that one, Caleb. So we typically charge between 3% and 7.5% of the sales price if we're going to represent you in the process. On average, it's probably between 5 and 6. It's simply a scale, so the larger practices pay a lower percentage and the smaller practices pay a higher percentage. Last year, on average, we averaged more than 30% of a premium when we sold practice on our platform based on the valuation. So 30% plus overvaluation. So we believe that the extra value that we add certainly is worth 5 or 6% if you're able to capture an extra, let's say 30 or 40% in value. Do we have any other questions? Well, at this point, it doesn't look like we have any more questions. So I want to thank everyone for joining us today. Hopefully you learned some things. Hopefully you've downloaded our white paper. And I would encourage you to schedule an appointment with one of us to learn more about how we can help you with your practice. So take care. Thanks again for coming, and hopefully we'll see you at our next webinar. Thanks.